Most retirees don't realize this. You can do everything right, save diligently, follow all the rules, and still get hit with a bill that costs you hundreds of extra dollars every single month for the rest of your life. It's called IRMAA, and it's the Medicare surcharge that quietly ambushes retirees who withdraw from their 401k at the wrong time or in the wrong amount. Today, we're going to break it down slowly and clearly. By the end of this video, you will understand exactly how IRMAA is calculated, which retirement account withdrawals trigger it, and 3 strategies to legally reduce or avoid it completely. If you're between 55 and 70, this video could save you thousands of dollars. And I mean that literally. Let's start with what IRMAA actually is, because most people have never heard of it. IRMAA stands for Income-Related Monthly Adjustment Amount. That's a long way of saying if your income is too high, Medicare charges you more every month for Part B and Part D coverage. Here is the critical thing most people miss. IRMAA is not based on your current income. It is based on your income from 2 years ago. Medicare calls this the look-back period. So if you retire this year and your income looks low, Medicare is still looking at what you earned in 2023. A high-earning final year at work can follow you into retirement and cost you immediately. Medicare uses your MAGI, Modified Adjusted Gross Income, to determine your IRMAA bracket. MAGI includes your wages, Social Security, pension income, capital gains, and 401k withdrawals. Everything. For 2024, if your MAGI as a single filer is below $103,000, you pay standard Medicare premiums, around $174 per month. But cross that threshold by even $1, and you jump to the next bracket. Let me show you the 5 IRMAA brackets. This is the chart most financial advisors should show their clients, but rarely do. Single filer, under $103,000, standard $174 a month. $103,000 to $129,000, you jump to $244. $129,000 to $161,000, you're at $349. $161,000 to $193,000, now $454 a month. And at the top bracket, above $500,000 for a single filer, Medicare Part B alone costs $594 per month. That's $420 more per month than the standard rate. Over a year, that's an extra $5,000. Now multiply that by 5 or 10 years of retirement. A single poorly planned 401k withdrawal in 1 year can cost you $25,000 to $50,000 in excess Medicare premiums over your retirement. That is real money. For married couples filing jointly, the thresholds are roughly double. Under $206,000, standard rate. Above $206,000, IRMAA kicks in. Each spouse pays the surcharge separately, so it hits twice. Here's the part that shocks people most. IRMAA is a cliff, not a slope. It doesn't phase in gradually. $1 over the threshold and your entire premium jumps. Not just the excess, all of it. So how does your 401k withdrawal trigger IRMAA? Simple. Every dollar you pull from a traditional 401k or traditional IRA adds directly to your MAGI. It counts as ordinary income in the year you take it. This is why timing matters so much. The year you retire is often the most dangerous year. You may have had a full salary for 6 months, then took a large 401k distribution to cover expenses. That combination can easily push you over the threshold. Required minimum distributions, RMDs, are another major trigger. Starting at age 73, the IRS forces you to withdraw a minimum amount from your retirement accounts every year. Those withdrawals count toward your MAGI. Here's a real example. Meet Carol. She's 72. She has $1.2 million in her 401k. Her RMD this year is approximately $46,000, combined with her Social Security of $24,000. Her MAGI is $70,000, still under the threshold. But Carol also sold her vacation home this year. Capital gain of $85,000. Suddenly, her MAGI jumps to $155,000. She's now deep in the 4th IRMAA bracket. Her Medicare premium more than doubles immediately. This is not a rare case. It happens to retirees constantly. A home sale, an inheritance, a Roth conversion done too fast, or a lump sum pension payment. Any one of these can trigger IRMAA without warning. And remember, IRMAA doesn't apply to this year. It applies 2 years from now. So a big income year at 63 will hurt your Medicare premium at 65, right when Medicare begins. That's the cruelest part of the timing. The good news? IRMAA is not permanent. It resets every year based on your income from 2 years prior. One bad year does not doom you forever, but one bad year can absolutely cost you thousands. Now the part you've been waiting for. 3 proven strategies to legally reduce or avoid IRMAA. These are real tools used by fee-only financial planners. Not tricks, not loopholes. Legitimate tax planning. Strategy 1. Roth conversions in your low-income years. If you retire at 62 but delay Social Security until 67, you have 5 years of relatively low income. That is the perfect window to convert traditional IRA money to Roth at a lower tax rate. The beauty of Roth conversions is that future Roth withdrawals are tax-free and don't count toward your MAGI. So money you convert today reduces your future RMDs and your future IRMAA exposure permanently. But, and this is critical, Roth conversions themselves do count toward your MAGI in the year you do them. So you need to convert carefully just under the IRMAA threshold, not over it. This is precision work. Strategy 2. Qualified charitable distributions. QCDs. If you are 70 and a half or older and you give to charity, this strategy is one of the most powerful and underused tools in retirement planning. A QCD allows you to send up to $105,000 per year directly from your IRA to a qualified charity. That amount counts as your RMD, but it never appears in your MAGI. It's as if that income never existed. If you donate to church, a hospital, a university, or any 501c3 organization anyway, you should be doing QCDs. Most people who qualify have never heard of this strategy. Ask your financial advisor about it this week. Strategy 3. Spacing your withdrawals across multiple years instead of taking a lump sum. If you need $150,000 from your 401k, taking it all in 1 year might push you into a high IRMAA bracket. Spreading it over 3 years keeps you safely below. This is called income smoothing. It requires planning ahead, ideally 2 to 3 years before you need the money. But when done right, it can save you thousands in Medicare surcharges without sacrificing a single dollar of withdrawal. One bonus strategy worth mentioning, if you had a significant life event that reduced your income, you retired, lost a spouse, divorced, you can file a IRMAA appeal with Medicare. It's called a life-changing event appeal. Medicare can use your more recent income instead of the 2-year look-back. Many retirees qualify for this and never file. The form is SSA 44. I'll put a link in the description. It takes about 20 minutes to complete. Let me show you how this all works in a real example. Meet Robert. He's 64, recently retired, and has $820,000 in his traditional 401k. He plans to start Social Security at 67. His spending is $5,800 per month. From 64 to 67, Robert has no salary and no Social Security. He needs about $70,000 per year from his 401k. His MAGI that year, $70,000. Well under the $103,000 threshold. He pays standard Medicare at 65. Now here's what happens if Robert panics and pulls an extra $80,000 from his 401k in year 1, maybe to pay off his mortgage. His MAGI jumps to $150,000. He's now in the 4th IRMAA bracket. His Medicare premium nearly triples. By waiting just 2 more years to pay off that mortgage, or by spreading the withdrawal across 3 years at $27,000 each, Robert stays safely in the standard Medicare bracket and saves over $8,000 in premiums. That's the difference planning makes. Not complicated strategies, not tax shelters, just knowing the cliff exists and taking one careful step back from the edge. Here is your 5-step action plan. The exact steps to take before your next 401k withdrawal or retirement income decision. Step 1. Get your MAGI from 2 years ago. Pull your tax return and find your modified adjusted gross income. That is what Medicare is using to determine your bracket right now. Step 2. Project your income for this year and next year. Add up all sources, wages, Social Security, RMDs, any plan, 401k withdrawals, capital gains, rental income. See where you land. Step 3. Compare your projected MAGs to the IRMAA thresholds. Are you under $103,000 as a single filer? Under $206,000 as a married couple? If yeah, you're safe. If not, steps 4 and 5 are for you. Step 4. If you're near or above the threshold, choose at least one strategy from today's video. Roth conversion below the threshold. QCD if you're charitable and over 70 and a half. Income smoothing if you need a large withdrawal. Step 5. Review every year. Your income changes. The IRMAA thresholds adjust for inflation each year. Your Roth conversion strategy should be recalculated annually, ideally in October or November before year-end. If this video opened your eyes to IRMAA, please share it with one person you know who is approaching retirement. This is exactly the kind of thing most people find out about too late. You found it just in time. In our next video, we're going to cover the 3-bucket withdrawal strategy, a simple system for deciding which account to pull from first, second, and last in retirement. It's one of the most important decisions you'll make. Subscribe if you haven't yet. We post every week. Calm, honest explanations about retirement money, specifically for people in the 55 to 70 window who want clarity without pressure. One final thought. IRMAA isn't a punishment, it's just a rule. One that most people walk into blind. Now you see it, and seeing it clearly is the first step to navigating it wisely. Take care of yourself. You've earned it. Disclaimer. This video is for educational purposes only and does not constitute personalized financial or tax advice. Medicare rules change annually. Please consult a licensed financial advisor or CPA before making retirement income decisions.